All right, well, thanks, Grant, and thank you to all of you for attending today. It's just a great turnout. I think it speaks to the conditions that we have in the market today. Obviously, things have been rough last week in the public markets and again yesterday. So I think we're all engaged in this as stakeholders in the public sector, and thank you for your attention today. I'd also like to thank Erez for the invite to come and speak, and to Bahar for organizing all of this. So I'm going to cover 8 topics today. 6 are more, I would say, gatekeeper slash initiatives that we're taking at the exchange, and 2 are more regulators, if you will. So we're going to talk about our white paper and town hall meeting that we're going to be having, some of the waivers that we're doing right now, so some financing waivers, shareholder waivers, sponsorship waivers. I'll talk a little bit about our new policies as well, financings and loans, and rights offerings and financial statements. So we have announced back on December 17th, John McCoach, president of the Venture Exchange, engaged a large number of us internally and talked to a lot of our stakeholders. Went across the country talking to various different people, talked to about 100 people, spent at least an hour with each of those 100, said, hey, what's wrong with the world today? What can we do to help? From that, crafted a white paper, basically that we published. The link to the white paper is down there, the Revitalizing TSX. It's about 6 pages, covers 3 main topics: reducing clients' administrative and compliance costs, and to expand, and this is what we're trying to do, is to expand the base of investors financing these companies, and to enhance the liquidity out there, and then also to diversify and grow the stock list. So as a result of that white paper, we're going to be having a town hall session next Thursday, January 28th at 2 o'clock, Robson Square. If you want to register for that, the link's down below there. Just quickly, we have 2 hours scheduled for that session. I'll try and bring it in about 60 to 90 seconds here. For the reduction of admin costs and compliance, basically what we're talking about there is sponsor waivers, shareholder approval waivers, and online filings. I have some slides, I'll be going through those. Some other ones that I won't be covering in detail would be PIFs. Right now you have to file a PIF every 3 years. We're looking at making that every 5 years. Do a file and go system for certain transactions, so private placement, shares for debts. If you file with us and get confirmation we've received that filing, if you don't hear back from us within 3 days, then consider it automatically approved and off you go, kind of thing. The second point, expand investors and liquidity. Basically, we're going to be doing a lot of more showcasing our issuers, roadshow type activities. Our BD group is handling that, and that there'll be more on that coming out. The holy grail for all of us is to get more participation from U.S. investors, obviously the biggest pools of capital down there. There's nothing new there, but we are dedicating more resources to make that happen. My understanding is it's going to be a fair bit of heavy lifting, but it's something that we're up to the task to do. That's in its, to be honest, it's in its infancy, but it's been tasked to certain people, and they're starting to get rolling on that initiative. But that's the main one we're trying to get. We've also come up with a TMX Investor app. It's gone through production, and we'll be unrolling it in Q1 2016. And just quickly, it basically trolls CDR for any news releases being issued by public companies announcing a financing. And then it pushes out summary information like the company name, the amount of the financing, contact information for the public company, and pushes that out to users. Users can then switch through and say, okay, well, do I want to participate in a private placement, a public offering, debt financing? Scroll through the app and say, okay, click that link. It'll take you to that company's webpage on TMX Money, and then there's contact information for them to contact the company. That's in hopes to stimulate the investing. As a few have said, there is a generational shift out there. A lot of people are now looking on handhelds and not participating, like especially the millennials. I'm not even sure if they know what the venture exchange is. So if we can get more in front of them and get their pockets opening to hopefully support our issuers. And then lastly, to diversify the issuer list, we've basically engaged a sales team, not just a BD team, but actually get people in that are actively grinding the market to get listings in through to the exchange. Not entirely sure how they are going to structure that, but I know John would be quite happy if they were the highest paid people at the exchange, because that means there'd be lots of business coming through and building out the stock list. The other thing we'd be looking at is revising our capital pool company program. For those of you that aren't aware of it, it's basically when you have a shell company that's listed on the exchange with a good quality management team. They go out looking for a transaction, and when they find one, they acquire it, and then they continue listing as a public company. Now, having said that, in this market, there are a lot of shell companies out there besides CPC companies, and so the CPC program as a whole needs to be revisited and restructured, and that will be forthcoming. Hopefully we can reinvigorate that program and also support the issuers out there that are currently looking for deals. The other one is also to get some alliances with some other exchanges out there. What we have is a deal with Santiago Stock Exchange, and by listing with us, you can also apply to list with Santiago, and when you list down there, you get access to MILA, which is an association of basically, I think it's five countries in South America, that once you get posted on the Santiago Exchange, other shareholders in those other countries can easily trade that stock. So the hope is that any issuer with mining properties down there or businesses based in South America, that can get you increased attention down there. Okay, so I mentioned one of the things we're trying to do to decrease burdens on the venture issuers is the pricing. I mean, we have lots of issuers trading at below 5 cents. So in April of 2014, we actually announced some criteria where we would allow financings below a nickel. Principally, it's the rights offerings, a pending share consolidation, and or a waiver requirement. Basically, the rights offering is pretty simple there. Since it's allowed or available to all the current shareholders, we're allowing them to price down to a penny. I got a slide coming up where I'll go a little bit more into that based on the new changes. Pending share consolidation, if an issuer is currently trading at 2 cents and proposes, say, a 3-for-1 consolidation, so in theory 6 cents after consolidation, they could price it off of that 6 cent price, and we would allow them to effect that financing now, as long as we have certainty that consolidation will happen in the future. So you don't necessarily have to consolidate first and then do the financing. If you're cash strapped, you need the cash in now to make a property payment or whatnot. Some companies are incorporated in BC, and if it's in your charter documents that you can incorporate based on a director's resolution, then we can allow you to consolidate, do the financing at, say, 2 cents on the undertaking provided by directors and officers that you'll consolidate within X period of time. Furthermore, if you're need to go to actual shareholders, but you want to get some financing in the door now, what you can do is basically announce the 2 cent financing, announce that you're going to go to a meeting for the consolidation, because our policies require shareholder approval for that consolidation. And if you can demonstrate before you go to the shareholder meeting that you already have a controlling block that would support it, then we can use that evidence and allow you to do the financing ahead of time as well. In terms of the other criteria, there's basically 8 criteria. It's all published in this notice that we issued on April 7th, 2014, but just quickly, if the issuer is not a next issuer, and after the financing, it'll meet continued listing requirements. It's not an inactive issuer, basically. We don't want issuers to finance below a nickel just for the fact to basically finance an inactive company. If you have an existing business and you're just trading down low because the prices are low and everybody's struggling, but you have property payments to make, you have payroll to make, you have a bona fide reason to get the financing in to justify your existing operations, then we would entertain those circumstances to do those financings. Basically, it's a lifeline financing. So when it comes to if you do need to do a financing below a nickel, which unfortunately that is a lot of what we're seeing right now, there are financings of 100,000 to 300,000 and or financings 5 to 20 million. So mining companies still are financing if they have a significant asset, and if they don't, then it's the 100,000 to 300,000 type keep the lights on financing. Technology issuers, what I'm seeing generally for new listing issuers, out there. The financings are generally in the $1.5 to $3 million range in terms of new listings, and follow-on financings can be all over the map for the technology issuers. Basically, just please come and talk to us if you ever need a waiver of policy. Meeting with us is free. Filing with us later when you do the transaction, obviously we charge for that, but we can hopefully help you structure the transaction to make it expedient for you. Hopefully take some deal uncertainty out of the transaction and get you moving forward. Okay, so in terms of policy amendments and changes, earlier in 2015 we put out policy amendments for private placements and loans and bonuses. Basically, those changes were not really substantive in nature. They were just done to formalize our current practice and streamline the policy for more clarity, really. So what were some of the changes that we had for policy 4.1? It eliminated the expedited private placement system, and I'll speak to that a little bit more later. Basically, we got rid of expedited private placements because we've developed a fully automated filing system. I'll talk to that in a minute. For policy 5.1, we had a few changes where basically bonus shares and warrants now have to be priced on market price and not on discounted market price. And we've actually increased the amount of bonuses that you can pay on warrants. So instead of 40% warrant coverage on loans to issuer, you can actually have up to 100% warrant coverage on loans to issuers. Right now, it's really difficult, as I'm sure you guys are aware, to finance and actually get an equity financing in. Everybody wants something convertible or a loan with some sort of bonus feature. And so we heard that, and we increased the amount that you could put bonus warrants out there. Because basically, at least when you're doing bonus warrants, when those warrants are exercised, that should be cashed into the till of the issuer. So that's why we increased the limit. And then we also stated some max commissions for the financing. So you can do up to 12.5% in shares as a commission for a financing, or up to 25% warrants on a financing. So as I mentioned, Vfile, we've got that new automated system out there. Basically, it's a web-based portal, so you can go through the internet, and it's effectively a digitized version of our existing Form 4B. It looks exactly the same as our current Form 4B, which is the notice form you need to file when you file a private placement with us. It's very efficient, so it provides immediate policy validation. You go through the Form 4B, put in the various different information: company name, price you're issuing the shares at, finder's fee information, warrant information. And as you're going through the form, basically you complete that information, and if you think you're done, you hit submit, and before it submits, it does a validation, and it says, you get basically a do not enter sign next to whatever the error is. You hover over that do not enter sign and it'll have a little box saying, okay, well, you priced this too low, below market. Do you want to apply for a waiver? You can still do that, and or it just triggers you to complete whatever the missing information is. Right now, what it is operating as is we do have, for lack of better terms, some test checks running in the background that are automated with that system. So it'll generate a report when you hit submit on our end that says, hey, it's priced in accordance with policy, but the stock is taken off afterwards, or it's technically priced okay, but the price for the 5 days before was 20 cents and 5 days after was 20 cents, and they priced it somehow at 5 cents. So there's some flags in there, but in terms of if it meets all the policy requirements and the flags aren't touched, in theory, when we take the reins off of the automation part of it, it should theoretically be submit the private placement, it'll do the validation, and then generate a bulletin and give you final acceptance within a matter of hours, kind of thing, and potentially within a matter of minutes. Right now, since we've gotten rid of the expedited private placement, and we are definitely supporting and promoting this, we are basically jumping on these types of submissions first when they come in. We've had at least 350 registrants signed up for this. We've had at least 200 private placements completed and submitted via Vfile. And we are doing currently demos. So of the Vfile system, we've gone around to most of the law firms in town, and done demos as to how the system works, and they've invited out their clients to that event, and we are now moving through the audit firms as well. So if you work for a group of companies or would like further information on this, please feel free to reach out to me after this, and we can get you some seats to the next demonstration that we do. Okay, so putting on the regulator hat for a minute here. We came out with a new policy in 2015. It's basically our emerging market issuer policy, and it went live in July, and basically it sets out additional requirements applicable to the listing of emerging market issuers, and it effectively enhances or complements some of our other policies, basically our initial listing requirements, our sponsor requirements, how you go about the listing procedures, the directors, officers, and the review guidelines. So, okay, great. What is an emerging market issuer? We've got a couple definitions, and basically the emerging market jurisdiction there is basically anything outside of North America or Canada, US, and Western Europe, Australia, and New Zealand. We've also managed to exclude and have a few transactions filed with us based out of Israel, Japan, and South Korea that we've excluded from the emerging market jurisdiction definition as well. And that just basically, there's different requirements. If you have a full-blown emerging market issuer, you have to comply with enhanced requirements around certain items. I'll get to that in a second. An excluded resource issuer, the one at the bottom there, if you are a mining issuer, put that definition in there for basically to carve out management teams that are working abroad. So if you have a North American team or a European team of individuals and the property's in Africa, even though technically your business is in Africa, we're not going to say you're an emerging market company if all the people running the business have expertise in the North American markets and running a mining company. So there's reduced burden there. So what do we focus on as part of the emerging market issuer? It's the qualifications and management and the corporate governance. So we've had a few issuers come in. We've actually listed one out of China that was a mining company, and one that is a steel reseller. And basically you have entrepreneurs from foreign jurisdictions that come in and they list their company as a public company, but they retain a very significant portion of the share structure. So we want to make sure that those individuals and the board as a whole are able to communicate. So to the extent that some speak English and some speak a foreign language, how are they going to bridge that gap and be able to effectively report back on Canadian standards? Qualification of auditors. We do basically, when a file comes in, we say, okay, well, who's going to be doing the audit? How do you have expertise to do not only an audit of a public company, but to audit foreign operations in the jurisdictions over there, so that they can demonstrate the ability to know the various different business practices in that other jurisdiction as well. And I've had numerous conversations with Erez, as he's quite the globetrotter for his various different filings. So there are various firms out there, but if you're thinking about doing a transaction with an emerging market issuer, please feel free to give us a call and come in for a pre-file meeting early so we can talk about what points to look out for. In terms of financial reporting, which may interest the group here, is we look at also the disclosure controls and procedures, and also the internal controls over financial reporting. So to that extent, even though the issuer is listed on the venture exchange, when it's an emerging market issuer, we ask for the certification to be provided to us, not posted on CDR, but just presented to us before we list the entity, that the CEO and CFO are basically comfortable with the DCP and the ICFR that are in place for an emerging market issuer. Non-traditional corporate structures and capital structures, there we're looking for basically entities that have access to the operating business on a purely contract basis. Those cause us more heartburn than companies that have direct ownership of the operating entity via a subsidiary basis. Legal matters regarding title and operations, those are, I think, common business practices for everyone in this room. If you're operating in a foreign jurisdiction, we're going to see legal opinions and title opinions on to make sure there's a good chain of ownership through the operating assets. And then sponsorship requirements for emerging market issuers. There's more back and forth with sponsors, confirming the various different due diligence steps that were done when you're working with an EMI issuer. The other component that probably has a little bit more overlap with what we've been talking for the first half of today's session. These are just basically common filing items that we have noted when we're reviewing financial statements in conjunction with a qualifying transaction, RTO, change of business. Those types of transactions we do the principal vetting of. A prospectus offering the principal vetting is done with the Securities Commission. So for us, when we're going through our items, the higher level items, and they're pretty basic, but you'd be surprised as to how many people come to us with some issues like this. Basically, the interim financials that get presented to us, generally when they come in the door, they haven't been reviewed by an auditor yet, and they still have the notice of no auditor review on those interim statements. So we got to get that not only removed, but actually make sure those interim statements are subject to an auditor's review. A large part of the time, the statements, actually the accounting principals don't have a statement of compliance with IFRS for the annual financial statements or with IAS for the interim financial statements. Also, the target company statements don't generally have earnings per share calculation in there, which needs to be in there pursuant to IFRS. Also, the consent letters, and it goes to changing auditors on a regular or semi-regular basis. This problem can come up, and it affects the deal timing. So companies think, oh, well, we got a consent from our current auditor for our current audit report, but we've got a comparative year in there, and we don't have that consent yet. Obviously, we need consent from both auditors before they can go live with their disclosure document. But in the meantime, they've been selling their financing. People have been subscribing to the financing, and now people are getting antsy that their money's tied up, deal hasn't closed yet, but now they're in the background trying to resolve the consent letter issue. So in terms of putting a deal together and doing it on a timely basis, you want to address that point pretty early on in the show. Also, predecessor entities and significant acquisitions, and basically, is what you're buying a business, and how do you deal with that pursuant to IFRS 3? So in those situations, we usually, have a pre-file meeting, talk with the client, talk with the auditors, usually ask the client to put together their analysis with IFRS 3 in the situations where it's kind of walking the line as to is it a business or is it not. And then we'll review their summary with it and just make a determination. So it's using the judgment that a lot of us in the room have been trained to do. So. Last point is 2 years of financial statements versus 3 years of financial statements, and I'll go into that a little bit more here. So basically in June 30th, 2015, the Prospectus Rules changed, which was great. It basically said you can file a prospectus and you only need 2 years of financial statements, which is very much applauded. Thank you very much. It helps all of you do a prospectus offering and only have to prepare 2 years of financial statements. So that's what basically that first bullet point says. The second bullet point, though, says that part of the policy didn't change to affect RTOs, COBs, or QTs. So in theory, you still need 3 years of financial statements if you're doing a transaction of that sort, and that's where we do the principal vetting. So we've definitely been in constant communication with this, Carla Marie and Mike Moretto over at the Commission. And it is definitely possible to get a waiver of that third comparative year. So if you're putting together a deal and you don't want to pay the cost of a third year's financial statements, definitely come and talk to us early. The process is basically we look at what you want or your proposal, put a summary together, send it over to the Commission. Commission says, okay, based on this structure, yeah, we don't object to just 2 years. And we talk about it internally, but basically we want to help you guys with alleviate the cost. So to the extent that the commissions are on side and we're on side, then we confirm back to you early in the process, yeah, okay, you only need 2 years of financial statements. And but in order to make that happen, we have to have both the Commission and us on side. And it's something that we want to do for you, but it's easier to do ahead of this early process instead of late. The proposed rights offering amendments. So the CSA did actually publish new rights offering guidance on December 8th, so just last month. And we knew the changes were coming, but it takes us a little bit longer to get the policies through. So what we did is we actually published basically just a bulletin to issuers. It's not actually changed our policies yet, but it's just summarized what we intend to do with the rights offering process. And basically it shortens the record date required of advance notice of your record date from 7 days down to 5 days. It now allows you to finance using a rights offering as low as a penny instead of a nickel. Right now, our policy says you have to list the rights. It gives you the option not to list those rights. And those first 3 points are waivers of our current policy. So if you intend to use those items, then the news release that discloses the rights offering not only has to talk about all the terms of the rights offering, but also that you're applying to the venture exchange for a waiver of those items. The last point there, new large shareholders. We have taken the position that if the rights offering is going to create a new control person that effectively would be created as a guarantor for your rights offering, as long as the rights offering is priced at a significant discount and those rights are going to be listed, then we won't require shareholder approval for a change of control. If the rights offering is going to be priced basically at market or above market, so there's really no incentive for current shareholders to participate in the rights offering, then we would require shareholder approval for a change of control, because in all likelihood the only person who's going to be stepping in is the guarantor in that situation. So if it looks like it's basically being manufactured to get a new control block created without shareholder approval, then we're going to ask for shareholder approval. If it looks like, hey, everyone's got a shot at it, it's priced at and everyone has an incentive to participate because of the discount, then we'll let it go and see how it rolls out. All right, and the next point I have up there for waivers of shareholder approval. Basically right now, policy says that for any reverse takeover or change of business, you need to get shareholder approval for that transaction. Given the market reality out there, it is terrible, obviously. I know my staff, I started the 2015 with 21 people, ended the year with 14 people. And it's been a lot of culling in the industry as a whole. So I feel your pain, and we're all in this together. So as part of moving this forward, when you have a capital pool company doing a qualifying transaction, that whole process is set up that if you find an arm's length transaction, you don't need to get shareholder approval for that qualifying transaction. Using that same logic, we are applying that to reverse takeovers and change of business. As long as you're filing an arm's length transaction and the current issuer is effectively a shell company, so that could be a company on NEX, on notice to go to NEX, or a TSX venture company that you can demonstrate to us has pretty much been inactive for the last year or two, which there's a fair bit of those circulating out there. It also needs to be in good standing, so not subject to a CTO, not subject to a suspension order. And if you meet those 3 criteria, then we'll waive the requirement for a shareholder approval for your transaction. So that can save you time. You don't have to do a mail out for the meeting, and it can also give you deal certainty as well. You know that deal is going to be going through. You don't have to wait for shareholder approval. Now, when times are good, shareholders, I haven't seen them vote down transactions, but particularly in the last year, and in particular where there's issuers with some cash in the till, I've actually seen shareholders starting to vote down proposed transactions. So, having certainty without having to go to shareholders on an arm's length deal actually does provide some certainty on your deal terms there. If you want full guidance as to that particular notice, the link's down at the bottom there. Waivers of sponsorship. This is what keeps us in pre-file meetings on a routine basis these days in the market. We do have competition out there. There are other avenues to list a public company. And the biggest single one that we hear is sponsorship. That's the single most expensive, and there's not a lot of perceived value add there. And based on a lot of the input we've received, we have been recently very active in entertaining sponsor waivers and granting sponsor waivers, and hopefully saving our issuers a lot of cost. Not only is the agent going to charge you for the sponsor fee, but they're also going to engage their counsel to vet the transaction. So that's great, but what are we looking at there? And just one second. I got it. Effectively, we're looking at, okay, well, if we're going to waive sponsorship, what do the initial listing requirements look like? And If you meet initial listing requirements, if the board of director meets a high standard, if the target entity that you're going to be acquiring has a demonstrated track record of revenues, if it's a tech company, if they've demonstrated the ability to raise financing in the past. So maybe they don't have a broker involved now, but they raised money a couple of years ago down in the States. Or the concurrent financing is of a sufficient size to justify waiving that requirement as well. We'll look at those too. We intend to be publishing again a notice as to the various different requirements when we're entertaining sponsor exemptions, and that should be forthcoming in Q1 this year. Having said that, we are pretty much, I've got 5 new listings in the last 2 weeks, and 4 of them need a waiver of sponsorship, so we're moving those along on pretty much what our proposed guidance would be. So if you have a transaction you're entertaining of taking public and or structuring right now, please come in for a pre-file meeting and we can walk you through what you need to do to put in a strong submission for a waiver of sponsorship.